There is this belief that if you have higher interest rates, the start of a rate hiking cycle, the financial conditions have to tighten, the equity markets have to fall. I can think of several experiences in recent financial market history where quite the opposite has happened. I can think of the tightening experience going into '07, where equity markets continued rallying really aggressively, even as rate hikes started to come through quite quickly. Can you envision a similar scenario taking place this time around? I just see deeply negative real interest rates and think, how much work does the Fed need to do to actually tighten financial conditions?
Yeah, historically, when we look at what goes on in a rate hiking cycle, throughout the tapering and even through the first rate hike, you continue to see equity markets rally. And we don't really see the equity markets take a hit until maybe that second or that third rate hike. Again, if we're looking at June as a first rate hike, even if we say it's March, you're looking at the second half of this year before it starts to affect equity markets. And yes, we have these really low real interest rates, and it's going to take us a while to get those up. So you have low rates for the equity market. That will help valuations for a while, even though I think they start to come down a little bit from current levels of where they are on the valuation side. But I still think you have strong support for the equity market, at least in the first quarter, possibly the first half of next year. Then I think we start to have a little bit more concern and see sideways growth for the equity market instead of continually trending higher.